Welcome back to the deep dive. Last time, we took a really good look at Heineken Malaysia's full-year results for 2024.
That's right. We talked about that record dividend, their growth, how they were handling debt.
Mm.
Quite a lot.
Yeah, exactly. And their strategy moves. If you missed that one, maybe check it out. The link is there. It gives some, useful background for today.
Definitely. Because today we're focusing on Heineken Malaysia again, but specifically their latest report, the Q1 results for fiscal year 2025.
Right. We want to see if that positive trend from last year is, well, continuing, and what new insights are hiding in this fresh data.
And we've got a fair bit to go through here.
We do. We've looked at the Q1 financial report itself, the dividend info, key financial ratios, their leadership and strategy stuff.
Product performance details, a Q1 review summary, a news piece on the results, their own outlook, even our notes from the last deep dive.
And the press release, plus a scorecard thing, assessing their financial health, and moat for Q1.
Well,
Quite the stack.
it is. So our mission today really is to pull out the most important bits for you. How did they actually do in the first 3 months of 2025, especially after that strong 2024 finish?
And we'll be keeping an eye on those things you care about, ratios, dividends, any potential red flags popping up.
Where they're headed, what management's doing, and of course, how the beers are selling. Okay, let's get into it.
All right, let's dive straight into the main numbers. Q1 2025 versus Q1 2024. Revenue first.
Okay. Revenue came in at RM 763.63 million. That's actually down about 3% from RM 789.17 million in Q1 last year.
Down 3%. Okay, why was that?
Well, the main reason seems to be the timing of Chinese New Year. It's quite interesting, actually.
ISO.
This year, CNY was in January, so a lot of that usual pre-holiday buying, the sell-in, happened back in Q4 of 2024.
Ah, right. Whereas last year?
Last year, CNY was in February, so that whole festive boost landed squarely in Q1 2024's sales figures. It's more about when the sales were booked, you know?
Gotcha. So a timing thing more than anything else. Okay. So revenue dipped slightly, but what about profit? That's often more telling.
Exactly. And here, things look remarkably stable. Profit before tax, PBT, was RM 160.933 million. That's like almost identical to the RM 161.285 million in Q1 2024.
Wow, really held steady then. And net profit?
Same story, basically. RM 122.154 million this Q1 versus RM 122.483 million last Q1. Very stable.
And I guess earnings per share followed suit.
Yep. Just a tiny dip to 40.44 sen from 40.54 sen. Almost negligible.
So maintaining profitability despite that revenue dip.
Yeah.
That's pretty good. What does that suggest?
It really points towards effective cost management. They must have kept a tight rein on expenses or maybe found some efficiencies somewhere.
Any specific examples?
Well, look at their interest expenses. They were lower about RM 3.1 million this quarter compared to over RM 4.2 million in Q1 2024. That shows better financial efficiency.
Right. Holding profit steady like that, even with less revenue coming in the door, that does suggest some underlying operational strength.
It does. It shows resilience.
Okay, let's switch gears to dividends. Always a key topic for investors. Any news for Q1?
For this first quarter ending March 31st, no. The board didn't recommend or pay out a dividend for Q1 itself.
Okay, no Q1 dividend. But remind us about the big one from last year, the FY 2024 final dividend. We mentioned it in the last deep dive.
Yes, absolutely. Important to remember that one. They previously announced that single-tier final dividend of 115 sen per stock unit for the full year 2024.
115 sen. That was quite substantial. What are the key dates for people to watch for that?
Right. So the ex-date is June 24th, 2025. You need to own the stock before that day.
Okay.
The entitlement date is the day after, June 25th, and the actual payment hits bank accounts on July 23rd, 2025.
Good to have those dates clear. Now, thinking about the payout ratio, how much of their earnings are they returning? Were we able to calculate the full FY 2024 ratio based on this Q1 info?
No, unfortunately not. The Q1 report and the sources we have for this dive don't give us quite enough to figure out the full FY 2024 payout ratio. We'd need the total dividends for the whole year alongside the full year profit.
Right, makes sense. We just had the final piece here. Okay, let's move on to some other financial metrics, those key ratios. What jumped out from the Q1 numbers?
Well, one thing is their net assets per share. That actually increased. It went up to RM 2.19 as of March 31st this year.
For what?
It was RM 1.79 at the end of December 2024. So a noticeable increase.
And what does net assets per share sort of indicate?
It's basically the book value of the company's assets spread across each share. So an increase suggests the underlying asset base per share has gotten stronger.
Okay, sounds positive. And debt. We talked last time about how they'd improved their debt situation significantly in 2024. How's that looking now?
That positive story continues, yeah. They actually fully repaid RM 80 million in borrowings during Q1 2025.
Fully repaid 80 million.
Wow. Yeah, like paying off a big chunk of a loan, it definitely strengthens their balance sheet further and improves that debt-to-equity ratio even more.
And just remind us, that ratio compares debt to shareholder equity, right? It had already improved a lot.
Exactly. We mentioned last time it went from over 31 at the end of 2023 down to under 17 by the end of 2024. This repayment pushes it in the right direction again, makes them look financially more solid.
Definitely a good sign.
Yeah.
Now, what about cash flow, specifically cash from operations? I think last time we noted a potential dip there based on the full-year trend. What happened in Q1?
This is interesting. The Q1 2025 numbers actually show a really strong positive turnaround here. Net cash from operating activities was a positive RM 121.376 million.
Positive 121 million. How does
Yeah.
that compare to last year?
Well, in Q1 2024, it was actually negative RM 94.135 million. So that's a huge swing.
Whoa, yeah. That's significant. What does that imply?
It shows a much stronger ability to generate actual cash from their day-to-day business this quarter. They weren't just profitable on paper, they were bringing in the cash.
That's really encouraging. So pulling all these financials together, stable profits, lower debt, strong cash flow, are there any potential red flags we should be aware of from this Q1 report?
Well, that slate revenue decrease is there, but like we said, the CNY timing seems the likely culprit, so probably not a fundamental demand issue flagging danger right now.
Okay.
And the lack of a Q1 dividend, again, that can be normal depending on their payout cycle. It's not necessarily a warning sign in itself.
Right.
Looking just at the Q1 financials themselves, honestly, no major new red flags really jumped out.
That's good to hear.
Yeah.
But there are always those wider economic things, aren't there?
Oh, absolutely. And the company acknowledges them. They talk about ongoing inflation, pinching consumers, global economic uncertainty, that persistent problem of illicit alcohol.
Yeah, the material litigation we mentioned before.
Right. But the report doesn't suggest any major worsening or new developments on those external fronts or the litigation specifically during Q1. There are known challenges they continue to face.
Okay. So looking forward then, what's the vibe from management? What's their outlook and strategic focus now?
They expect consumer sentiment to, well, stay under pressure from inflation and those global uncertainties. No big surprise there, really.
Seems realistic. So how are they planning to handle it?
The plan is basically stay agile, be adaptable. They want to drive revenue growth through specific, targeted commercial activities, and critically keep a tight grip on costs. Discipline is the word they use.
Makes sense. And are they sticking with that broader EverGreen strategy we discussed?
Yes, absolutely. That's still the guiding framework. They're continuing to execute on it.
Can you quickly recap the main pillars of EverGreen for anyone who missed the last deep dive?
Sure. It's built around 5 key things: achieving superior growth, funding that growth by being more efficient, boosting sustainability efforts, becoming the best connected brewer using tech and data, and unlocking their people's potential.
And are we seeing concrete examples of that in action?
Yeah, definitely. Things like launching new products. They mentioned Tiger Soju and Edelweiss Peach, expanding their Drinkies e-commerce platform to make buying easier, plus ongoing investment in training their staff.
And are they putting money behind this?
Yeah.
Investing in the future?
It looks like it. Their capital commitments for things like property, plant, and equipment are still sitting at around RM 14.4 million. That suggests continued investment in their capabilities.
Okay. And any mention of government policy?
Yeah.
Like excise duties?
Yes, they actually noted their appreciation that the government kept excise duties on beer unchanged. They see stable duties as helpful in fighting the illegal alcohol trade. And they reiterated they're committed to helping the government tackle that issue.
Right, that illicit trade is a constant battle.
Yeah.
Let's talk more about the products themselves. How are the big established brands doing? And what's the strategy with these newer drinks like Tiger Soju?
Well, the core brands, your Heineken, Tiger Beer, Guinness, Edelweiss, they're still the bedrock, the foundation of the business. The new launches, like Tiger Soju and Edelweiss Peach, that's clearly about broadening their portfolio, tapping into different tastes, maybe younger consumers, evolving preferences. It's diversification.
Makes sense. And are they just launching new stuff or also working to keep the main brands fresh?
Oh, definitely the latter, too. They mentioned several campaigns aimed at keeping those core brands relevant and engaging, like Heineken's Celebrate Boring campaign.
Yeah, I saw that one.
Tiger Beer had its Together We Roar for CNY, Guinness pushed St. Patrick's Day. It's all about connecting with consumers. And expanding the Drinkies platform also helps keep their brands accessible.
But, as always, there are challenges too, right?
For sure. That economic uncertainty we keep mentioning, it could definitely impact how much people are willing or able to spend on beer and other drinks. That's a risk. And again, that shadow market, the illicit alcohol, it constantly eats away at potential revenue for legitimate players.
Understood. Okay, finally, let's just touch on Heineken Malaysia's wider role. They're a pretty big player in the Malaysian economy, right?
Oh, undoubtedly. It's worth repeating that huge tax number from 2024 RM1.45 billion. That was 52% of their total revenue. It really highlights their significant socioeconomic contribution.
That's a massive chunk going back into the economy.
Yeah.
And it's not just taxes, is it?
No, they're also active on the sustainability front with their Heineken Cares program. They mentioned focusing on things like water conservation and supporting food security.
And it seems like these efforts across the board are getting noticed.
Yeah, they listed quite a few awards and recognitions they've received recently for brand strength, sustainability initiatives, digital innovation, things like the Putra Brand Awards, accolades from the UN Global Compact Network, and others.
Okay, great. So let's try and wrap this up. What are the main takeaways from this Q1 2025 deep dive into Heineken Malaysia?
Well, I think the main picture is one of stability in profits, despite that slight revenue dip, which seems mostly down to the CNY timing.
Yeah.
We saw really strong positive cash flow from operations, which is great news. They continued to manage their debt prudently, paying off a good chunk, and they're clearly sticking to their EverGreen strategy.
And it sounds like management has its eyes open to the potential challenges ahead.
Absolutely. They seem very aware of the economic headwinds, inflation, uncertainty, but they appear to have a clear plan to navigate it. Stay agile, control costs, and keep investing in their brands and future growth. Plus that ongoing commitment to sustainability.
So here's a final thought for you, the listener, to chew on. Given that stable profit and strong cash flow this quarter, even with that CNY timing effect, how well-positioned do you think Heineken Malaysia really is to handle the economic pressures we expect for the rest of the year and keep growing? What parts of their strategy, the new products, the efficiency drive, maybe their digital push with Drinkies seem most promising or perhaps most concerning for their long-term prospects?
Yeah, good question. And if you want more context, definitely feel free to go back and listen to our previous deep dive on their full year 2024 results. It sets the stage nicely. And naturally, we'll keep watching how things unfold in their future reports.